Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday everybody. Just a heads up, today's video will be very housing crisis focused. And a quick note before we start, UK-based The Guardian is reporting that General Secretary Xi Jinping is expected to travel to Saudi Arabia next week. Analysts point out, correctly, that if this is the case, it would be a very big deal, representing Xi's first overseas trip since January 2020. It would also have implications for US-China interests in the region. However, as at filming, the trip has not yet been confirmed, so there is no need to indulge in speculation. We will discuss the trip and its implications when and if it happens. Okay, first up, this latest outbreak, which we have been following since the weekend, appears to have legs. Nervous officials have so far failed to stamp out community cases, which are now affecting the wealthy coastal regions of the country. Sanya, the beach resort city in Hainan province, where this latest outbreak started, saw infections triple in a day to over 1,200 for Wednesday. A scary number for authorities, as it's the first time daily cases have exceeded 1,000 in any city or province since Shanghai was in lockdown in May. The provincial government set a goal of achieving 0 community infections in Sanya by Friday, today. So it appears extremely unlikely that they will achieve this. Perhaps more nerve-wracking for officials, however, Shanghai has discovered 2 positive cases, prompting the city authorities to lock down several residential compounds across 2 districts in the megacity. And more may be on the way. At a press event yesterday, Thursday evening, the deputy director of the Shanghai Center for Disease Control and Prevention warned of cluster infections, saying, quote, "The 2 positive cases have been to some densely crowded public venues, such as wet markets, supermarkets, and foot massage parlors." End quote. Also yesterday, Yiwu, the world's largest commodities hub in East China's Zhejiang province, entered a largely citywide lockdown, euphemistically called static management, by authorities. The lockdown is officially set to be in place for 3 days. And the Tibetan prefecture-level city of Shigatse, or Rikaze in Mandarin, population 800,000, which hugs the Nepalese border, also entered citywide lockdown yesterday. Okay, next up, and for the remainder of the video, the housing crisis. As we've seen over the last few weeks, Beijing seems to have finally thrown in the towel and begun introducing large-scale bailouts for troubled developers, largely undermining the original intention behind the regulatory tightening of the sector back in 2020. That is, fighting moral hazard and forcing deleveraging on the over-leveraged sector. We remember that in the first several months of the crisis, most of the pain was felt by developers themselves, facing a hit to financing and liquidity combined with crushing debt, as well as bondholders who saw their asset prices collapse as defaults increased. And almost a year on, more pain is set to be on the way for these bondholders. According to Moody's Investors Service, developers have $27.7 billion worth of onshore bonds and $34.2 billion worth of offshore bonds maturing or becoming puttable over the next 12 months. Since last year, home sales have crashed and continue to perform badly even now. Home prices, artificially sustained through de facto price floors, have seen more modest monthly declines, but the trend is not positive. There was also a flow-on effect to suppliers, which we have covered, who were owed billions of dollars for services rendered to large developers. Despite all of this, Beijing regulators kept to their guns in Q4 of last year, confident that they could achieve the much-needed reform for the sector, deleveraging developers, reducing financial risk generally, and rebalancing economic growth towards healthier sectors. However, by Q1 this year, the true size of the challenge came into view, and one of the more painful systemic results of the Chinese housing crisis reared its ugly head: the effects on local government revenue. The collapse in housing sales, combined with crushing liquidity pressure and in some cases de facto insolvency, caused private developer demand for land to disappear, taking a critical source of local government revenue with them, just as local governments were being told by the central government to boost economic growth through expansionary fiscal policy. It is in Q1 and Q2 is of course when Shanghai saw its massive lockdowns, that we saw loosening of regulations and restrictions on both the demand side and the supply side of the housing market, especially at the local level across the country. Yet, still at this point, widespread bailouts were not on the table. But in the last month or so, the calculus has changed. The movement of home buyers, frustrated with apartments not being built, boycotting their mortgage payments, though only in small numbers, seriously frightened policymakers. Why? Well, first, if the movement spreads, it could mutate into a serious banking crisis. And second, because of these boycotts, this is now a social stability concern, and thus a political issue, not just an economic one. Like any serious political concern, policy readjustment came from the top. A meeting of the Politburo, the parties, and therefore China's highest decision-making body, on July 28 called for action to, quote, stabilize the real estate market, end quote, directing local governments to ensure the, quote, timely delivery of homes under construction, end quote. This represented a political direction from the highest level of government to subsidize, bail out, or nationalize thousands of private developer projects across the country. And we are now seeing policy implementation. According to a state-owned provincial newspaper, Zhengzhou, the provincial capital of central China's Henan province, has set up the Zhengzhou Real Estate Relief Fund, a bailout fund starting with a few $1 billion, which, quote, will leverage contributions from SOEs, state-owned enterprises, and banks to complete construction of unfinished projects that have stalled due to a lack of funding, end quote. We remember from earlier in the week, Huarong Asset Management, a giant state-owned bad debt manager which is itself being bailed out by even bigger state-run banks, announced it's bailing out another developer. And developer Greenland Holdings Corp Limited also announced in recent days that two state-owned enterprises are helping it fund the completion of several major projects involving thousands of apartments. We should expect dozens, if not hundreds, more of these types of examples across the country in the coming weeks. Indeed, in a report published earlier this week, China Real Estate Information Corp expressed, quote, we believe more cities may follow Zhengzhou in setting up bailout funds, and more financial institutions will actively bail out developers and revitalize non-performing assets, end quote. Analysts continue to warn, however, as we have discussed before on China Update, that these bailout funds, even if they reach hundreds of billions of dollars in value, are simply drops in the bucket compared to China's overall property market. The expensive bailout has two primary objectives. One, to prevent further spreading of the mortgage boycotts, and two, to revive market confidence and let demand stimulate growth once again. The first objective is possible, but the second will be far more difficult to achieve. Quote, the policies of only rescuing unfinished projects won't be enough to solve the problems in the property market. End quote. Indeed, many analysts argue that much more is needed. Quote, I think more assistance will come and will likely intensify, but as long as the three red lines are in place and banks have limits on lending to developers, these bailouts are akin to using balm to soothe wounds that really need surgery. End quote. Some viewers in recent weeks have complained that this channel seems to have been talking about this Chinese housing crisis for months now. And yes, it has, but that is because China has been grappling with a housing crisis for months now. Indeed, almost a year. The country will continue to do so for months more, and we will continue to follow it. It appears, based on some comments too, that some expect a Lehman Brothers moment, a visceral event of some sort to point to that represents or proves the housing crash or collapse. And while some symbolic event, which future historians may point to, may present itself in the future, it also may not, or that symbolic event may end up being Evergrande's original default. At any rate, the crash has already happened, and it continues to happen. Much of the pain of this crash has already been felt and spread, and will continue to be spread over millions of households, investors, and business owners. While all this may not feel as real to some of us viewing from afar than, say, a Wall Street bank going bankrupt, a stock market crash, large-scale political unrest, or a German wall being pulled down, it's certainly real enough for these millions of people who have been affected, and it's very real for the economy as a whole. The damage and cost of this ongoing crisis will also manifest itself in the continued misallocation of resources through moral hazard or public sector attempts to maintain politically acceptable growth levels, as well as debt, which will drag down future growth. And there may be worse still to come. On this point, dear listeners, as we conclude this video, I hope you will permit me to indulge in a vice that I typically try to exercise from these videos, that is giving you my personal opinion. There has been a lot of talk in recent weeks in pundit circles about China's imminent political collapse. On this point, let me just say this. It is my view that China's economy is currently going through a painful transition from an unsustainable, debt-driven growth model to a much slower but more sustainable one. A transition which, if mismanaged, will result in very painful economic and social fallout. However, it is the humble opinion of yours truly that full industrial or political collapse due to the housing crisis remains very, very unlikely. Beijing still has plenty of political and policy tools in its toolbox to prevent such an outcome. But I possess not the gift of prophecy any more than the next man, so ultimately we will see. Whatever happens though, however the crisis unfolds, we will continue to follow it here, together, on China Update. Hey guys, if you enjoyed today's video, don't forget to hit the like button, and for anyone who wants to help me continue making these videos possible every day, Patreon and Buy Me a Coffee links are in the description below. This is one of the best ways to help me build a channel for you guys, which is primarily supported by subscribers like yourself, rather than corporate sponsorship. Okay, that is today's video. Thank you so much everybody for watching. Thank you for the ongoing support. I will see you all tomorrow.